What happens when you buy an ETF? And how does it actually track the underlying assets, like stocks or bonds, that it's supposed to mirror? To understand this, let's break down the process step by step. Think of an ETF like a box that holds a small piece of many different assets. When you buy a share of an ETF, you're essentially buying a tiny piece of that box and all the assets it holds. But here's the surprising part. The ETF itself doesn't actually go out and buy all those individual assets. Instead, it uses a clever system to track their value. The process starts with something called an authorized participant, which is usually a big financial institution. This institution buys or sells the underlying assets, like stocks or bonds, and then exchanges them with the ETF for shares of the fund. This creates a market for the ETF that's tied to the value of the underlying assets. And here's the key point. The price of the ETF is determined by the market forces of supply and demand, but its value is ultimately based on the net asset value of the underlying assets it tracks. So, how does the ETF stay in sync with those assets? That's what we'll explore next. Vocabulary: ETF, assets, authorized participant. What happens behind the scenes when you buy or sell an ETF? And how does it actually track the underlying assets? An ETF works by using a mechanism called creation and redemption, which is essentially a swap between authorized participants, like big financial institutions, and the ETF provider. Here's how it works. When an authorized participant wants to create new ETF shares, they gather a basket of the underlying assets, let's say a group of stocks, and exchange it for a corresponding number of ETF shares. This basket is designed to mirror the composition of the ETF, and the swap is done at the net asset value, or NAV, of the underlying assets. And here's the surprising part. This process is what keeps the ETF's price in line with the NAV of the underlying assets, because if the ETF's price deviates too far from the NAV, authorized participants can step in and profit from the difference by creating or redeeming ETF shares. Think of it like a seesaw. When the ETF price is higher than the NAV, authorized participants can buy the underlying assets cheaply and exchange them for ETF shares, which they can then sell at the higher price, and vice versa when the ETF price is lower. This mechanism is what keeps the ETF's price anchored to the value of the underlying assets, and it's a crucial part of how an ETF actually works. By understanding creation and redemption, you can see how ETFs maintain their tracking ability, and that's a key insight into the inner workings of these popular investment vehicles. Vocabulary: redemption, authorized, net asset value, composition, underlying. Ever wonder who keeps an ETF in check, making sure it holds its value and operates smoothly? That's where authorized participants come in. Think of them as the behind-the-scenes conductors of an orchestra, ensuring that all the instruments play in harmony. Typically, these authorized participants are large financial institutions, like big banks or investment firms. Their exclusive role is to create and redeem ETF shares directly with the ETF issuer. But how does this really work? Imagine a bakery that sells a special kind of bread only through certain distributors. If demand for that bread spikes, the bakery can't just bake more bread on its own. It needs those distributors to handle the logistics. When an authorized participant sees that an ETF is trading at a price higher than its net asset value, or NAV, they can step in. They gather the underlying assets, like stocks or bonds, that make up the ETF and deliver them to the ETF issuer. In exchange, they receive new shares of the ETF. This process adds more shares into the market, which helps bring the ETF's price back down to align more closely with its NAV. And here's the surprising part. This mechanism not only keeps the price in check, but also enhances liquidity. When investors want to buy or sell shares, there's always a ready supply, thanks to these authorized participants. They act as market makers, ensuring that there's enough volume for you to trade without causing wild price swings. So, authorized participants play a vital role in maintaining the efficiency and stability of ETFs. Their actions help to create a smoother experience for everyday investors like you. Understanding this can make all the difference in how you view the market dynamics at play. If that intrigues you, stick around to learn more about how ETFs operate behind the curtain. Ever wonder how ETFs manage to track an index so closely? It all comes down to a process known as index tracking. Think of it like a well-choreographed dance. The ETF aims to move in perfect sync with the index, whether it's the S&P 500 or a sector-specific index like the Nasdaq Biotechnology Index. Now, there are two main ways ETFs achieve this synchronization. The first is called full replication. Imagine you're at a buffet and you want to sample every dish. Full replication is when an ETF buys and holds every single stock in the index, just like you filling your plate with one of everything. This method works best for indexes with a manageable number of components, allowing the ETF to closely mirror its performance. But what happens when an index has hundreds or even thousands of stocks? That's where things get a bit more nuanced. Enter sampling and optimization techniques. Picture a chef trying to recreate a complex dish with limited ingredients. Instead of grabbing everything, the chef carefully selects a few key ingredients that provide the same flavor profile. In the ETF world, this means the fund managers choose a representative sample of the stocks that capture the overall performance of the index without needing to own each one. The surprising part? When ETFs use these techniques, they can still achieve returns that closely resemble the index. However, this can introduce tracking error, which is the difference between the ETF's performance and that of the index it aims to replicate. Understanding this is crucial as it highlights the trade-offs involved in ETF investing. So, the mechanics of index tracking and replication are what allow ETFs to deliver on their promises of performance. Next time you look at an ETF, you'll know there's a synchronized dance going on behind the scenes. If you found this insight helpful, consider subscribing for more explanations that break down the complexities of the market. When you invest in an ETF, have you ever wondered how the fees and taxes might affect your returns down the road? It's a crucial part of the equation and often gets overlooked. Let's break it down. First, think of an ETF like a shopping cart at your local grocery store. Sure, you're excited to fill it with all those fresh, good quality items, or in this case, a diverse collection of stocks or bonds. But just like a grocery cart comes with a rental fee, in some places, ETFs have fees too, known as the expense ratio. This is calculated as a percentage of your investment and typically covers management fees, administrative costs, and other operational expenses. Even a small percentage can add up over time. For example, an ETF with a 0.5% expense ratio might not seem like much, but over 30 years, it could eat into your returns significantly compared to a fund with a lower fee. And here's the surprising part. It's not just the upfront fees you need to worry about. Taxes play a big role in your net returns. ETFs are generally more tax efficient than mutual funds because of how they are structured. When an investor sells shares of an ETF, it's usually done on the open market, which minimizes capital gains distributions. This means you're not faced with unexpected tax bills on gains every year, as you might be with other investment vehicles. So, when you're considering an ETF, take a close look at both the fees and the tax implications. These factors can significantly impact your long-term investment goals. They can either boost your returns or drag them down over time. As you think about your investment strategy, remember, it's not just what you earn, it's what you keep that counts. If you want to dive deeper into how to navigate these costs effectively, subscribing can keep you informed. Vocabulary, expense ratio, tax efficiency, capital gains, net returns. Now that we've taken a deep dive into how an ETF actually works, from its creation and redemption process to tracking indices and managing fees, it's time to connect the dots. So, how do all these pieces come together to benefit you as an investor? Think of an ETF as a well-organized toolbox. Each tool inside represents a different asset, whether it's stocks, bonds, or commodities. When you buy an ETF, you're essentially purchasing access to that entire toolbox, not just one tool. This means you can diversify your investments without needing to buy each individual asset separately. And here's the surprising part. Because ETFs are traded on an exchange like a stock, you can buy and sell them throughout the day, taking advantage of price changes in real time. The beauty of ETFs lies in their efficiency. The mechanism of creation and redemption, where authorized participants can trade shares for the underlying assets, helps keep the ETF's market price in line with its net asset value. This is a critical feature that many new investors overlook. If the ETF's price drifts too far from the value of its underlying assets, these participants will step in to correct that imbalance. And let's not forget about fees. While some investment products can carry hefty costs, ETFs typically have lower expense ratios, which can add up to significant savings over time. Plus, their tax efficiency means you might keep more of your returns in your pocket. So, with this understanding, you can now appreciate how ETFs function beneath the surface. They're not just a trend, they're a sophisticated tool for building a diversified investment portfolio. If you found this explanation enlightening and want to explore more about the markets and investing, you know what to do. Hit that subscribe button for more in-depth insights.